Bitcoin is really sound money. I'm a believer in that. But Wall Street is going to be building products and tokenizing products. They're not going to be building on the Bitcoin blockchain. To me, the price of Ethereum probably goes up a lot in the future because
Tom Lee maintains a pragmatic but bullish view. He sees Bitcoin as digital gold, a perfect store of value that also transfers value better than any asset ever created. It's sound money, built for an age of financial uncertainty. But while Bitcoin dominates the store of value narrative, Lee believes Wall Street's future infrastructure, tokenized assets, securities, and real-world financial products will be built on Ethereum, not Bitcoin. The reason is simple. Ethereum enables smart contracts. Wall Street needs programmable layers for settlement, compliance, and automation. And Ethereum has already proven itself with 100% uptime and over 2/3 of all decentralized value creation occurring on its network.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
people are willfully overlooking that valuations are actually, they're dynamic. You know, from 1940 to 1967, the 10-year went from 2% to 6%. And everyone should say PE should have fallen in that 27-year period. The PE went from 8 times to 27 times. So in other words, as nominal rates rose, earnings accelerated, and so the PE went up. And that was in a time when 70% of the earnings generated were cyclical. Today, most of the earnings is recurring revenue in the S&P, which is higher multiple. And in fact, the 10-year bond is at 4%, it's at 25 PE. I mean, the bond market's expensive. So yeah, so I think you're correct. I mean, plus in the last 5 years, we had 6 black swans. We had COVID. We had the supply chain bullwhip effect. We had an inflation bubble, the Fed's fastest hikes in history. We had the tariff terrors and US bombing Iraq's nuclear facilities. 6 black swan events. And the market grew earnings during that time. I would argue PE should be higher because we just battle tested the stock market. You know, in that 6-year period since COVID, earnings delivery has been amazing.
I mean, substance has been there.
Yeah. So like even this quarter, 85% of companies are beating results right now. And it's still going to result in basically 15% earnings growth. I mean, so that's not late cycle earnings growth. Late cycle would be single digits. So companies are still finding ways to grow margins and earnings. And there's plenty of multiple expansion. I mean, financials, business results look more like tech companies now, but they still trade like financials. So I think there's a lot of groups that can re-rate higher is digital gold. So it's storing value, and it stores value and it moves value exceptionally well. I mean, Bitcoin is really sound money. I'm a believer in that. But Wall Street is going to be building products and tokenizing products. They're not going to be building on the Bitcoin blockchain, you know, because they need a smart contract platform. And as you know, if you look at whether Solana or Ethereum, if you look at the total value locked, about 1/3 of that value, gross value, becomes the intrinsic value of the chain. Like that's been the floor for Solana and Ethereum. The global economy is 80 trillion, but it's understating because, you know, GDP is a final sales concept. So let's say it's 120 trillion. You can't put 120 trillion onto one public chain because like this Ethereum would be like, you know, $20 million because there's just so much value locked up on it. So there's going to be room for more than one L1. But Ethereum has been the place that's been capturing more than 2/3 of all the creations. It's had 100% uptime, but almost every project that's been announced is a layer 2 on Ethereum. So I mean, I'm not against Solana or Avalanche or these other chains, but as an institutional grade blockchain, Wall Street's building it on Ethereum. I think crypto really has forced us to rethink what I call like rent seeking really looks like. Because Bitcoin, the community is capturing the value. That's why the Bitcoin blockchain grows in value, is because it's all the energy required is reflected in the price. In smart contracts, I think it's proving that it's a fat protocol. So instead of TCP/IP being the base layer for Ethereum, whatever you're staking and operating on Ethereum, the value is captured on the blockchain itself. It's acting as a monetary base. So to me, the price of Ethereum probably goes up a lot in the future because, just as a simple mechanical measure, if BlackRock and Goldman launch stablecoins and they have tokenized stocks and it's an L2, but it runs on Ethereum's L1, they'll want to care how the L1 upgrades. So they're going to eventually own Ethereum. So then if 20 investment banks buy Ethereum as a balance sheet reserve, as much as they hold Bitcoin as a reserve, then the price of Ethereum is going to go up a lot. Crypto is full of experimentation. But then once in a while, a handful of these companies break out into the mainstream and they've turned out to be better businesses. Stablecoin is an example. A tokenized dollar functions better than the US dollar right now. Exhibit A on companies is Tether, because Tether today has only 150 employees that have been there more than 12 months. I think they might have more than that now. But they're valued currently, according to the media, $3.3 billion per tenured employee. And they earned $20 billion, which would make them a top 10 most profitable bank. At $500 billion, they're second only to JP Morgan, which is valued at $869 billion. JP Morgan has 313,000 employees. Okay, so JP Morgan's valued at $2.8 million per employee. Tether's valued at $3.3 billion, and they're making more money than every bank in the world, and twice as valuable as Goldman. That's a breakout. Polymarket as a prediction market functions far better than the CME, but the real breakout was the 2024 election. The prediction market for Polymarket called 50 of 50 states correct. Nate Silver's model, New York Times, none of these models were even close. Only Polymarket called the election in 50 of 50 states. And as we just mentioned, Trueflation, to me, and I've watched its correlation to yields and spreads and even the curve, it's a better predictor of how markets are reacting. So Trueflation, which is a blockchain-based inflation tool, works better than CPI. And Trueflation comes out every day.
Lee's fascination doesn't stop at assets. He's also focused on how we measure truth in economics. He points to Polymarket, a decentralized prediction platform that correctly called all 50 states in the 2024 U.S. election, outperforming every mainstream pollster and forecasting model. He also cites Trueflation, a blockchain-based inflation tracker that updates daily and has shown a closer correlation to bond yields and market behavior than official CPI reports. For Lee, these are not gimmicks. They're the future of economic data. Prediction markets and real-time blockchain oracles are transparent, decentralized, and immune to political manipulation. Unlike legacy surveys such as the University of Michigan's Inflation Expectations Survey, which he says has become politically biased and methodologically flawed since switching to online-only sampling.
For years now, I've been hearing folks who I would put in, they grew up in the stock market, they're kind of legacy system, supporters and participants. They don't really get the Bitcoin and crypto thing. They have forever been saying, you guys don't understand, there's a big crash coming there. You don't know what a real market downturn is, whatever. And I always just think, I'm like, do these people realize that the people holding Bitcoin have seen 2 drawdowns of over 80% in 4 years? That's never happened in the stock market.
Yeah.
Right. And so in this crazy way, actually the crypto people are more prepared for market volatility than the stock people. But it's like, if you haven't gone through the pain, you just don't think that it exists or something. Right. And the stock people don't acknowledge the fact that you kind of have to be insane to hold all the volatility in crypto.
Yeah. And actually what I've noticed, and it's not true of but I've met some crypto skilled traders And a percentage of them are exceptional equity traders.
Interesting.
They've become so good at the EQ of like market moves that they're great at stocks. Not every crypto trader, because a lot of crypto traders are just, degens, but so it really does cross over. I think being good at stock investing is not a skill that's learned at Harvard. Some people are just really good at it.
Well, to me, I've always thought the crypto market is much more of a pure free market kind of macro thing as to how it was originally designed. There's no hours of operations. There's no circuit breakers. These less algorithmic trading. It's just like very, very much how markets, I think, used to operate. Maybe
over the counter. Correct. True over the counter market.
And today the stock market is not that. And so you kind of have to pick up the skill in a pure market, and then that makes you better at the somewhat manipulated game.
Yeah. So I found some crypto guys are really even good at timing the market. They've been getting out at the right time. So it's.
Mm-hmm. Well, they're definitely good at recognizing the bank run. So every single crypto person who had money in Silicon Valley Bank, they got it out for sure.
Yeah.
This stock rally, you've called it the most hated rally. The recent sell-off because of Trump's tweet, you called a flesh wound. You're uber bullish. I am as well, so I'm biased. But why do you think it's so hated? Why do these people want the market to go down? Why do they want the U.S. economy to tank?
Yeah, I mean, people have taken for granted that surveys have always been done objectively or adjusted for what could be sampling bias. The UMich survey is the gold standard because it's been run for more than 50 years, and it's a measure of consumer expectations on everything from is it a good time to buy stocks, to buy a house, inflation. And it has an army of researchers. It's like a business at UMich. We've tried to contact them before, and we spent 2 hours walking through their methodology. It's an extensive operation. However, they provide the data, and so you can see the survey respondents. For instance, on the one-year inflation, that currently stands at 4.3%.
So 1 year from now, people think that inflation will be over 4%.
Yeah, which
collectively.
Is and that's the same level it was during 2022, during the inflation surge. Mm-hmm. So in other words, the UMich survey says consumers are expecting hyperinflation just like 2022. Mm-hmm. But here's the problem. If you look at the breakdown, Democratic respondents say it's 4.5 or 5.1. Republican respondents say it's 1. Okay. So obviously it's political when people answer. People who don't like Trump are going to say it's through the roof. In fact, of the Democratic respondents, 4% say inflation's 30%.
4% of Democrats who respond to the UMich survey say they think inflation next year will be 30%.
30%. So it's absurd, right?
We would love to find those people and trade against them.
Yeah, or they're the ones buying gold.
Yeah.
But the problem with this survey is not adjusting it for the generalized population. The U.S. is essentially 50-50 Republican Democrat. Mm-hmm. But the UMich survey now, 65% of the respondents in the past month were Democratic. And it was 49% 18 months ago. Mm-hmm. So now the survey is increasingly reflecting the results of Democratic views, which of course is causing the inflation expectations to spike, but it's not really spiking.
So is that something that is malpractice in the methodology? Is that intentional? Is that just naturally kind of flows over time and sometimes you get a little bit more Democrat, Republican? How do you view that as, okay, I want to use this data point in your research or kind of in your investment strategy? Do you throw it all out now and say, hey, we can't use this? Or how do you view it?
Yeah, so one of the issues is, of course, algorithmic systems and quant systems take that survey result and they put on trades. Mm-hmm. And the Fed has to react to that because the Fed cares about anchored expectations. And there's just 3 surveys they look at, that, the New York Fed, and Conference Board. UMich changed their methodology. They used to do telephone calls. They now do it 100% online. They mail it out, email it to people. Are the surveys only being emailed to certain people now? Or are they only, is there a finger on the scale? We don't know, but the process has, I think, become polluted. Yeah.
And so do you guys now just disqualify it and don't look at that survey anymore?
Well, we still reflect it because, believe it or not, most of our clients will point to say, Tom, inflation's out of control. Look what the UMich says. And then as I try to explain to them the methodology from, they're like, how come you're the only one pointing this out? So
you're smart.
Yeah. So I think prediction markets are the answer. So I think poly markets of the world where they're like, what is the CPI a year from now, might be better signal than using these surveys. I mean, I think it's going to push us towards alternative data, like even using trueflation is better than looking at CPI.
Let's talk about this for a second. So I am surprised at the explosion, let's say, of the prediction markets in sports betting. It makes sense, right? You're not betting against a house. You're not betting against a peer. The odds are a little bit better in your favor. It's easier, right? And there's these deep liquidity pools. There's more transparency. It's global. It's very clear to see why that is. But I'm also surprised that we have not seen more uptick of these prediction markets in kind of business and finance. For example, you're talking about CPI type inflation expectations, but also just things like, I always talk about like the Tesla delivery number. People will go buy the stock with the view that they're going to beat on deliveries, but they'll beat on deliveries and the stock will go down.
Yeah.
The prediction market isolates the data point. And so now you can just simply, speculate on that one thing, but we haven't really seen as big of an uptick in the finance community. Why do you think that is?
It's going to start changing because I think up until recently, Kalshi was the only market US institutions could trade with transparency because Polymarket was offshore. So like this is the year where Polymarket is now also available in the US. It'll move in sync with the tokenized stock world. So as we tokenize equities, and what you're describing is what I call factorization of a stock, we're going to start factoring stocks once they're tokenized. Because, for instance, if you take Tesla, you can do two ways to factor it. One is Tesla as a stock can be deconstructed into a AAA bond and then an equity tranche, which is like earnings for 2026. And you do 1 year forwards for every earnings, and the rest is a bond. That's how tigers and strips were created with treasuries.
Lee envisions a future where stocks themselves are tokenized and broken into components, what he calls the factorization of equities. Imagine Tesla shares being decomposed into two pieces, a bond-like cash flow stream and a speculative equity component tied to future growth years like 2026. That's the same concept as tigers and strips in the treasury market, separating principal and interest payments, but applied to corporate earnings. Once tokenized, investors could trade these pieces individually on blockchain-based markets, allowing precise exposure to revenue, margin, or growth expectations.